Morning, everyone. This is Graham Norris. I'm here with Remy. Remy sent me a large multifamily for me to analyze. It's a 216 unit. And what we're going to do today is we're going to go over the figures. Don't let this worry you too much. You can rewind it or what have you and watch as many times as you like. But it's why don't you start off, Remy? Tell us a little bit how you found this property and what you think of it. What are your thoughts as you've looked at the figures, and tell us a little bit about it.
Yeah, so I had a broker send it to me. I've been getting I've been searching for multifamilies, and I guess they found a couple of properties after that search that I did. So he reached out to me and sent that to me.
Mm,
I did ask him if it was a value add. So he did mention that it was a value add. So
mm,
that's when I figure I send it to you and see if I can also learn
mm.
some underwriting or learn how to what to look for.
Wonderful. That's great.
Yeah.
What were your first impressions with? I know you don't know everything yet, but I presume you looked at the figures and things. What did you think? Did you think it was a good deal or not a good deal?
I think it was a good potential for one.
Okay, okay. And is this one currently on the market?
Yes, I believe so.
Okay. So one of the things why we asked that question is that the ones on the market have been through the VIP list. Most brokers have a list of who's buying these large multifamilies because they're not kind of
Mhm.
ordinary investors. So brokers obviously they only get paid when there is a sale. And so they want to obviously first approach the experienced investors who they've done business before and they've bought other large multifamilies and they know they can close on these deals. Because the truth is, the buyers of these properties are usually syndicates, okay, who have investors. So it takes a while for a new operator or somebody new coming into this to build up that network and to have that power of the network to take down these large multifamilies. So a broker initially will go through their VIP list, and if they're a long established broker, that might be quite a long list and quite a long process before they've exhausted that list. And if you think about it, the experienced large multifamily operators have already seen this building, all right, and they've turned it down.
Right.
Yeah. So when it comes to market, we call it the trash bin. In other words,
Right.
it's been through all that process, okay, and all the experienced operators have turned it down for one reason or another. So it's very rare that we'll actually find a deal, a good deal that is being advertised on the market. Not
On the
impossible,
market.
okay? The other thing to bear in mind when they're on the market is they are advertising at the very best, highest retail price. Okay, and so there is what we call a whisper price, which is really what the seller will be prepared to let it go at. Okay, so
Hmm.
that's a bit of prelude to the situation. So when we're in the large multifamily space, the idea is to get onto their VIP list to get the real deals, as it were. But there'll come a
Right.
point in time um, where the seller they may lower the price on the market, and then that will restir activity again. So, do you know how long this one has been on the market, Remy?
I didn't really look at it. No.
Hmm. Okay, so when we do underwriting, that's one of the things we do. We see how long it's been on the market. And so,
Right.
for the purpose of this exercise, we're going to jump over that step. I'm going to share
Okay.
my screen as we start this process. So let's see. Here we go. I brought can you see my screen all right?
Yes.
Fantastic. So this is what Rami sent me, the offering memorandum. This is the pro forma. The Melrose comprises of 216 units. So this is a typical OM, and I'll scroll through this. So we give you a table of contents here, the team that are selling it, and some contact submitting offers, some instructions here. The investment overview, and we don't really need to worry about that. I look for figures, so this confirms it's 216 units. Gives you a square footage, building size. And what I scroll right away to is the figures. So what I've done here, can you see this here? This step 1, 2, 3, 4, 5, 6, 7?
Yes.
Okay, fantastic. So the first step, what we're going to do is find out what the local average mark cap is for multifamily. So we want to be able to compare this one with the ones around us and see what sorts of market we're in. So we find out the local market average rent per door, and I've put in the URL here for us to find that out. So I've already prepared it. So let's have a look at that. So this URL takes us here, the cap rate list. And this is, if you notice, the city is Natchitoches in Louisiana. And I just put in the zip code. And what we do here is
Oh,
we just
awesome.
click on the city. And it shows that the average cap rate is 6.26. All right. So, and this is the range 5 to 8 points. So we're gonna go no lower than 5 and no higher than 8. So we're gonna write 6.26 on your pad if you write that down. All right. Let's go back to the steps. So we found that out. Find out the local per door. Okay. Find out what the local average rent per door is. So what we do there is I put in Google, you can put, let me show you Google. And this is for any market you want to find out what the local average is. Average rent per door. And this one is in Augustus, Georgia, but we can change that. And what I put in is the zip code, which, what is it in this case, Remy? 71457, isn't it? 71457. And then I put 2024.
Oh, wow.
And this is looking at the market first. So we're looking to see what the average per door is. So let's have a look. Right. Average price in 7144. That's Zillow. Let's see. Let's see what this one brings. There we go. Zillow's pretty good source for finding out information. So this is $850. So we'll write that down as the average. All right. Do you follow that, Remy?
Yes.
Yes. Okay. Okay.
Yeah.
All right. Your camera's out there. There we go. So we found out the average mark cap and found out the average rent per door. So we go to step 2. We use the NOI. Do you remember what that is?
Yeah. Oh gosh, I forgot what it. Mm, oh my
Net.
goodness, I know what it is.
Yeah, the net.
Net operation income.
Yeah,
Operational income.
yes, that's right. Net operational income. And what does that actually mean?
It's what the expenses and what the income is
That's right.
calculated at, right?
Yes,
The
yes.
balance of
We
that.
take away the expenses from the income and this
Yeah.
what the money left over. But it doesn't
Right,
include the debt service, okay? It's just the expenses, not the debt service, because
right.
different operators might have different amounts and it will be misleading to count in the debt service, and that's the reason for that. So we come out for this property. I believe it's if we scroll down, they do all the calculations for us. So let me magnify this. So I've got $786,330. Is that what you came to?
Mm-hmm.
Okay, very good. Now, we want to, obviously, when you're selling it, you're going to put on your best clothes, right, to try and sell it as it were. So these figures, we want to compare with the market and we want to judge it by the market, and so we're trying to get behind the curtain because some of these numbers might not be real, you see. So, um,
Right.
what we're on the expenses, we want to see is this realistic? Okay, so um, I'm jumping ahead of myself a little bit there. Let's go back to the steps. Okay, so now we're going to use the NLI on the offering, which was 786,330, to work out the fair market price for the complex. I'm going to divide that by NOI divided by the average local market rent. So do you want to get your calculator out? We're going to do some math
Oh,
now.
this is
Yeah,
good. I keep forgetting this part right here.
yeah, it's not easy.
Okay.
So we're going to plug in 786,330 and then divide that by what was the average market cap? Did we work out?
6.26.
26, wasn't it? Yeah. Yeah. So what I do is I divide by 0.0626. And then what do you get?
30. 30 million.
No, no, you did something wrong there. Try again.
Did?
Cancel. Seven eight
Um,
six three three zero.
76330.
Yeah. Divided by 0.0626.
Oh, 121 million. Is that right?
No.
Again.
Try again. Yeah, it's okay. This is why we're doing this, right? Because it's so important. So 786,330, and then divided by, and I just hit the point sign, 0.0626.
Oh, 12 million.
There we go. 12,561,000.
561. Yeah.
Yep,
Okay.
182. So that would be what we would be a fair market price to offer. Yeah.
Okay.
Now, what is the price that they're asking for this?
I don't remember it. I don't even have it in front of me.
Okay, it's
Do you
15
see it?
million. Yes,
Oh, 15.
50.
Okay, so it's too much.
Yeah, way
Got
too
it.
much. Like referring back to what I was saying earlier, that's
Hmm.
no surprise at all to me, right? Because they're
Right.
adding on or everything, and they know there's a negotiation price, and they know as well that they're asking too much money. And when we boil it down to just figures like this, using their numbers, and then the local market cap rate of 6.26, there's nothing to argue about. Would you agree with that?
Yes.
Okay. The second thing, the third step three is to do another formula to see how that works out. So this time what we're going to do is the average expenses on a large multifamily is typically 45% of the gross income. So what we're going to do, that's where the 0.45 comes in. And then we times that by 12, because there's 12 months in a year. And then we times it by the average local market rents. So we wrote that down earlier. What's the local market rent that we got? I think we wrote 850. Is that right? Let me just check. Yes. According to Zillow, the median rent is 850. Okay. So
850.
yes. So what we're going to do is we're going to put 0.45 on the calculator times 12 times 850, as that's the local rent per unit, and then press equal sign, and I get 4590. Is that what you get?
Okay, say that again. I was trying to write the notes down.
On your
0.45
calculator, yeah, 0.45
times 12.
times 12 times 850, because that's the average rent per unit in that zip code.
What did you get? 45990?
Yeah, 4590, yes.
Yeah,
Now we
got it.
divide that by the cap rate, and the cap rate was 0.0626. And then what do you get there?
7,332. Is that right?
No, you should have
Oh my gosh, it's such a close.
73,322.
Okay, out of the 4, 5,
0.45 times 12.
0.45.
Yep.
Oh, that's why.
850. Yeah. And then divide that by 0.0626, which is the average cap rate. And you should have 73,322.
Yeah, got it.
All right. Now, that's per unit, so we want to times that by 216.
216.
Yes, 216 units. And what did you get this time?
73322 divided by 216.
No, times 216.
Oh,
Yep, times 216.
15?
Yeah, 15,837,699. Okay.
Oh,
Now, what's so interesting about this is they've times it by 216, but 216 units are not rented out. Would you agree with
yeah.
that? Okay, so this is where the underwriting part comes in. And that's how they arrived at the 15 million. Do you see that?
Yes.
So somebody inexperienced will say, oh, well, they're asking a fair market price. I mean, there's 216 units. But when we underwrite, we've got to do it as is now, right? We've got to say, no, you haven't got all 216 units occupied, right? They're not paying that rent, okay? So what I do is on the income statement, how I work it out now for the building, I look at the total effective gross income, which is what you can see 1689999.
Yeah.
Okay. And what we've got to do, yeah, is if you look at the potential, it's 2,526,000. All right, so we got quite a lot of vacancies here. And if you look,
Yeah.
we should have vacancy loss somewhere here. Let me see if I can find it. Oh yeah, here, loss gain to lease is, they've got it as 68,761, which is the difference, you see? So they've lost that much in vacancies. And they've also calculated well here. So the total vacancy loss is 810,195. Do you see that? So let's write that down.
810.
195. So now for this building, what we do is we got to calculate for this building how much per door the loss is. So how many of the 216 have lost that income? So what I do here, I do the total effective gross income, which is 1689999.
Mm-hmm.
And I divide that by the number of units to find out what it should be.
Oh, okay.
So it looks like it should be 7,824. Did you get that?
I try to do notes, so let me try.
Yeah.
1689999. Divided by 260. What did you get?
7,824.
Yeah, 7,824 and 69.
Yes.
Okay.
And of course, if you divide that by 12, we can see the monthly rent. So let's do that.
Oh,
So it looks like they're getting an average of $652 a door, average monthly rent.
oh yeah.
All right. So now we can see how many vacancies we've got because we can do the total loss in vacancies, which is 810,195 divided by 652.
Mm.
Which comes out to 1242. Is that what you get?
Wait, 652, right?
Yeah, 652.
810. 195. Oh, what was that? 1,242?
1,242 and divide that by 12 because remember the 810 is gross, and we should get 103 units.
Oh yeah.
That's extremely high, isn't it? So 216 minus 103 is 113 units rented out, right? And 103 vacant units.
So another thing that caught my attention with this one, I also learned that when it's something that you want to kind of look to buy if they had management issues. And this property in his notes said that the managers they managed it badly and they were down like 70%
Yeah, they are.
vacancy.
Right.
So I'm not sure if it's good or bad. It could be good if you correct the management, right?
Yeah, absolutely. But there's a point at which we wouldn't take less than 70% is very hard to recover and it's not attractive
Okay,
to
okay.
investors. So 70% is the bottom figure. So we want to see what percentage it is. So 103 divided by 216, I've got as 47. So this is a no deal, 47.68% vacant. They're losing 810,000 potentially here at the moment.
Right. That's a lot.
So that's a big red flag. It's well under 70%. So
Mm,
it's not just bad, it's extremely bad.
okay.
Badly managed, right? And at this point, I would usually stop and I would look on Google for the reputation and see what sort of feedback it's getting. I would want to understand the problems and things like that. So we'd ask the broker, okay, we understand it's been badly managed, okay, but what can you tell me a little bit more about that? So I want to understand what the problems are, what they struggled with. Has something happened in the area to make the vacancies so bad? You know, there might not actually be 103 units that are vacant. There might be what we call economic vacancies. So they are occupied, but you have tenants not paying the rent. So this is using their figures. The vacancy on this was just $810,195. That's self-proclaimed. That's what they put here, that they've lost, you know,
Mm-hmm.
which is a significant amount of money. So we translate that into vacant units, but they may not be vacant. Now, the reason I say that is, what if half of those were occupied with people not paying rent? Can you imagine the eviction process and the expense of that to actually get them vacant? And I guarantee of those 103 units that we calculated, all right, that there are a good number of people not paying rent or not paying all of their rent. They're in default, okay, because we got above that, part of that 810, if you look here, is 39,274. It just says bad debt write-off. So what do they
Mm-hmm.
mean by that? Do they mean that's the defaulted rent? I mean, it's bad debt, and that's the only debt I can think of, you know, that's not there. So it's another red flag. Do you see that?
Yes.
Hmm. And so this is another reason why this is not a good deal. All right. So um, I'm guessing, of course, this is where another question for the broker to ask how many are actually vacant units, because then we'll know how many tenants are defaulting. Because one of the things they haven't done on this OM is the rent roll. And what we need is the rent roll. I don't see the rent roll. Did they
Oh,
send
I
it?
thought it was in here.
What's that?
I thought it was in here,
Okay.
the rent roll.
What page is it on? Because I don't see it.
I wonder if it's in my email.
And the reason why we have the rent, we want each unit, a line on each unit. I want to know the name and when they rented it out, how long they've been
Right.
there, and when the lease ends. And whether they, and then there's financial columns of whether they paid a security deposit, whether they're up to date with the rents and how much they defaulted on. And then we can see how many tenants on that rent roll, you know, we need to evict because it's going to cost money for each one to evict and loss of rental income for each month they're in there. And that's where the local market is important, to know the local market for how long it takes to evict a tenant. Like in Tennessee, it can take up to 3 months. It's really
All
long
right. Makes
process.
sense.
So you're going to lose money for every month that they're in there. You can't do anything. You can't improve the unit, and you can't advertise for a new tenant. So you're going to lose a lot of money there. So we did step 4, which is using the same formula, using the rent per unit on this building to find out what the situation is, how many vacant units there are. The next step, if there aren't any red flags, it's a red flag, you stop. You're not interested. Step 5 is check the expenses. a return value by percentage to see if there's any ways to cut expenses. There will be, because if you notice by their figures, their expenses are 53.47%. You remember that the average is 45%. So we're a good 8.47% too much in expenses. So what do we need to cut out? So we can look at that. One thing that does stick out is the payroll is very high for me. It should be about 10% of the income at the most, and ideally 5%. So the payroll's too high. They should be fired, okay, because they're doing a really bad job anyway.
Yeah, right?
That's another red flag. And then the repairs and maintenance, I mean, that's very high as well. 70,000. Yeah. I mean, what are they doing? Breaking windows or doors or toilets or something? I mean, that's a lot of money, you know? 70,000
Right?
is a lot. So that sticks out. Management fee, that's on the high side, 82,000. So, and you've already got payroll, and I would have included that, you know, so you got 80 plus 200 here, a lot of on staffing, right? 280,000 in that, you know, we can do a better job there. Also, this is kind of sneaky.
Okay.
Yeah, this is kind of sneaky as well. You see this? They're admitting these aren't even real figures. Okay, so note one, utility income in the market column is an assumption. We want some real figures.
Right.
This
Mhm.
is self-declared, right? On the thing that most people would miss, right? They just look at the numbers and the thing. And it says that the building is fully occupied. Well, it's not even half filled, all right? It
Yeah,
might
that
be
wasn't
more
right
half
from the
filled, but
start.
it's less than half that are paying the rent in this, so that's not good. So it's always a good idea to read these notes as well. I think we're going to be running it. We got 5 minutes left, so I'm going to speed up a little bit.
Okay.
All right. In fact, there's enough red flags there to probably leave it at that. We can always analyze it a bit more.
Okay.
Yeah, let's see what other steps for. So, maybe let's do a part two, Remy, if you like.
Okay. Sure.
Because steps 6 and 7 are very important. If we had green lights on the rest of them, we want to check the rent roll. So try and get the rent roll for this, and I can highlight, you know, what
Okay.
we're looking for on that, and highlight how many vacant units are and how many economically vacant units are. There's two different things there, and we can look at that. And then we can look at the value add, because once we get, that's the last step where we find out what we could do to improve the building, adding in facilities and things like that. And then what we look for is cap rate for the building at or above the local market. This one isn't. This is works out as 5% cap on this one, 5.24% with using their figures, and it's probably less than that. We want to see the ask price as step 2 or 3, which in this case we worked out as 12,561,000, but we would adjust for closing costs and things. So in all reality, we would probably be offering around the 10 million mark, okay, if we were to buy this. We want to see numerous opportunities to add value, which is RUBS, which is where the tenants pay the utilities. We want to see if we can add in fees and services, increasing the rent and improving the facilities. We want to see the occupancy between 70 and 85%. We worked out it was 47.68. And we want to see ways of reducing expenses. And in this case, it was 8% above the average. So this one has just about raised every red flag. out there. So this is definitely not a deal. You know, it's
It's a good learning curve.
it really is. It is, and that's why we'll do part two, because we'll go
Okay,
over those final two steps. And but I hope that's been helpful. We got 3 minutes
it's very
left.
helpful. Thank you very much, Graham.
That's all right. And you can watch, as I say, you can watch this video as many
Will
times as
do.
you like, and it'll help you spot the deals. And then when you submit a deal, we're both saving time then, yeah, and likely to get
Okay,
a deal submitted. So I really
right.
appreciate our interaction and how many times you've emailed and asked questions. I think that's wonderful. And this is an exciting track you're on. If we bag one of
Thank you.
you have a really nice payday. So it's worth sticking to this road. And just in
Okay,
conclusion, I put a lot of this, what we shared today, my 2 books I'm writing, and those should be coming out soon. Demystifying commercial real estate investing, and also uh, investing in large multifamily solved. So those 2 books will be coming out shortly, and they'll be available on Amazon. All right.
I'm reading one of your book, like this, the first one.
Okay, yes, the short one, that doesn't take long. Just
Yeah,
26 pages. These two
yeah.
are much thicker. They're about 150, 160 pages.
Oh, nice.
So they have a lot of information in. All right,
Cool.
fantastic. Well, it's been a real pleasure, Amy. And
Yeah,
yeah, book another call once you receive the rent roll off the broker.
okay.
Don't tell him
Will
what we
do.
shared about, and don't tell him this video's here because
Oh, no, I won't.
yeah, that that probably won't help, because we've been
Yeah,
brutally honest with the figures, and they don't like to hear that, right? The
of
other thing
course.
is, of course, don't forget that a broker needs to be paid. That is
Yeah,
substantial with these prices, so that makes it harder for the deal to work as well. So just
right.
left.
Okay.
All right, very good, Remy. Don't forget to
Thank
book a
you so
call.
much.
We have a good day.
I appreciate it.
Thank you. Bye
Okay,
bye
you
for
too.
now. Bye bye.
Okay, bye.
Bye.